Hello friends, welcome to the mini marathon of Module C. I have seen Module A and Module B marathons which I took yesterday and day before yesterday. Had a great response. Many of you have followed this and today's also. Kindly follow this. I will be taking very important questions on Module C, Treasury. Module C is totally related to Treasury. So don't miss even a single question. Many of the questions are repeated from the earlier exams only. So don't miss this. Watch this completely till the end. Share it with your friends. Share it on all your social media platforms. Like this video. First you like this video. Okay? So let's start and mind it. Kindly share it with your friends because the questions are very important. You will see many important repeated questions from the same or similar questions in the exam. Okay, so don't miss any of them. So let's start. Let me cover this basic. Nowadays, this treasury is not called as a treasury. It's called as integrated treasury. Integrated. Why integrated? What do you mean by this word integrated treasury? So note this. Nowadays everyone calls this treasury as integrated treasury. Okay? Integrated means what? Treasury integrates nowadays the banking business to the world business. Nowadays treasury integrates the banking business to the world. Means what? See here, you get, what does the bank do basically? Bank gets money, bank gets deposits. Now these deposits are invested. Bank gets deposit. These deposits are invested in two things. Invested means where does this money go? This money will go in two things. One is in loans and second is in your investments, treasury. Investments you can call it, investments. Who does the investments? See, this loan part is taken care of. This loans part is taken care of by the loan department. Bank, basically you can call it bank other than treasury. But this investment part is taken care of by the treasury. Now what does the treasury do over here in this investment? The treasury department over here will take this money and invest it in the bonds. Bonds. Okay? Bonds of whom? Now treasury can invest in various bonds. Bonds issued by RBI. Bonds, debentures issued by private companies. Say this. Let me write it. Bonds issued by government basically. Government means RBI. RBI issues it on the behalf of government. Or it can invest in debentures, private companies. Whenever any private company issues a bond, it's called as debenture. Whenever any government company issues the bond, it's called as a bond. Now these bonds can be of within our country Bharat, or these bonds can be of outside also. Treasuries are allowed to invest in sovereign bonds also, foreign countries. So this, because this treasury is doing the business, taking your money from the country and investing it outside. Or it can be vice versa also. Treasury can do the other job also. FIIs, foreign investors who want to invest in our country, either through two routes, either through FDI or FPI, foreign portfolio. There are two routes of investing in our country. One is FDI, foreign direct investment, and second is FPI, foreign portfolio investment. Okay? Whenever you are talking of FDI, foreign direct investment, so what does it mean? The company or the investor will purchase a land over here, start a factory, employ certain people. That is known as FDI, direct. FPI means what? The person will invest either in stock market, either in shares or in bonds. And whenever he gets the money, whenever he gets the profit, he'll leave. It's that simple. So that's why this treasury is called as integrated treasury now. Because the treasury is not limited to the local business nowadays. Okay. So coming back, let's move on now. Now with this basic of integrated treasury, let's move on. Which of the following activities are included in the treasury management? So which of them are included in treasury management? Fund management, risk management, forex operations, profit maximization. Okay, profit maximization in money market. So which of them is included? Treasury has which job? Does it have the job of fund management? Does it manage the fund? Risk management, does it manage the risk of the bank? What is risk management here? The risk management in treasury is limited to mainly, I'll tell you, mainly ALM, asset liability management. ALM. Main job of theirs is in ALM, asset liability management. Okay. So, risk management is the job of forex operations. Does treasury deal in forex? Yes, obviously. That is the main job of treasury, isn't it? So it will deal in forex also, plus profit maximization in money market. What is this money market? Money market. Money market is the safest market. Okay. Let me give you three types of markets. One is equity. Equity. Second is debt. DEBT, debt we call it, debt. B is silent, debt. And third is money. Money, or we call it liquid also. This is also called as liquid. Liquid. Okay, money market or liquid market, anything. In equity markets, you invest in risk instruments, stocks, shares. Debt market, you invest in medium-term instruments, medium risk, means bonds, debentures. These are having lesser risk than the equity. And last one is money market, liquid, zero risk, almost here. I would say exactly zero, 99.99% zero risk. Because in this, we generally invest in liquid bonds, like T-bills issued by government or any private, not private actually, government only. Because privates are over here. In this money market, we mainly invest in government and sovereign bonds, where the principal is safe. Principal should be very much safe. Okay? So, profit maximization in money market. Even when I invest over here, I must apply my brain as a treasury person so that I get a maximum profit. So which is the answer over here? All of the above. Okay, all of the above is the answer. Got it? Next one. Forex market is most liquid market for currency trading. When treasury parks its surplus for currency trading on the future date, it's known as the forex market is most liquid for currency trading. What do you mean by this? Forex market. Here, main dealing is done in forex market is based on currency only. Dollar, main is dollar right now. Okay, dollar is considered as a universal currency as of now. Universal currency. Universal means it's considered as a base currency. See this, you give your GDP in dollars, you give your any industrial output in dollars, everything is given in dollars. Not only you, all the countries in the world. Of course, there are nowadays fights going on over the BRICS. BRICS has come up now. BRICS is saying that no more a single currency regime. We want a multi-basket. So this is the fight going on, but that will continue. You don't know the future. After 5 years, what will happen, you don't know. So coming back. So forex market is the most liquid market. Obviously, everything is in the currency only. If your currency rate goes down, then there is a huge inflation in the country. When treasury parks surplus of its currency trading on a future date, it's known as future, swap, spot, forward or nostro. You want to book it for future date. First you give me the answer, then I'll give you some explanation on this. Let me see in the comment section. Yes, it is forward. Okay, forward rate. Kindly note, these are the types of, you can call it a type of derivative instrument, okay, where you try to minimize the risk. Now look at this, there are two types. One is forward, and similar to that, there is something called as future. Forward and future, they are almost similar. You might be hearing these words many times, forward, future. They are similar, only slight difference is there. That slight difference is this. In forward, there are two parties, buyer and seller. Okay? So there are two parties over here. In future, there are three parties, buyer, seller and exchange. Exchange is there in between. Okay, buyer, seller and exchange. What does it mean? Now here being the three parties, this exchange will control and decide on the rules of the game. What is the difference between these two? I'll give you a simple example. Suppose if I sell you, let's say, this pen. Okay, I sell you this pen. So there what is it? I am the buyer, you are the seller. Okay? So simple, forward transaction. Two parties. Now, if you buy the same pen through Amazon, now there is a third party over here. Amazon is in between. Exchange, who controls the rules. Amazon will say that this pen should be of this quality, only then you should, I'll be able to sell it. So when there are third parties, three parties, and they set the rules, exchange set the rules. One more example I'll give you. Whenever you buy the shares on BSE, NSE, anything, whenever you buy the shares, do you know the seller whom you have bought from? Do you know the seller? No, you don't know. Why? Because exchange is there in between. It never lets the buyer and seller meet each other. Okay, there is a pool created, pool of shares. Same logic is over here. Whenever you are dealing in forwards, forward is between single person, two persons. You know the buyer, you know the seller. Okay, so this is forward. What is swap? Swap is different. Let's go into, I won't go into full details over here now in swaps. Swap means basically, many of you are confused over swap. Okay. So one thing you remember, swap, there are three main principles about swap. One leg is fixed, leg one. There are two legs in swaps. Two legs, leg one and second is leg two. Okay. One leg is fixed, always fixed, and other leg is this floating. So this is known as swap. One leg is fixed, other leg is floating. Now you'll say, sir, what is the example? Some example in this? Yeah, example is there. Very simple. I'll take 1 lakh rupees from you. Okay, 1 lakh. I take it from you, and I guarantee you 7% rate. I'll take it from you. I'm taking it from you. 7% guarantee funds for fixed 7%. Now this is fixed because I have to give you 7%. Now this 1 lakh rupees I am taking from you and I am investing in shares. Now in shares, do I know what will be the returns? In shares I can get 100% returns, or I can get 0%, or I can get minus 100%. Anything can happen. So this leg is known as floating leg. Fixed and floating. Okay. So remember this concept, fixed and floating. Swap is basically the means you can call it the fight between the fixed and floating, or the trading between the fixed and floating rate. Generally it is done in currencies. Swap is done between the spot rate and the forward rate. Generally, because spot rate is fixed, forward rate is floating. Okay, so generally the trading is done between them. Plus, in swap Second point is it is always principal plus interest, P plus I. Both are exchanged. And here in complete swap, P plus I are exchanged. Only there is one swap. That swap is called an interest only swap. Interest only, where only interest is exchanged. Okay? Why did I give this point? Because in swap, similar to swap, there is something called as FRA, forward rate agreement. In there, only notional interest is exchanged. So swap and FRA, this question comes in exam. The difference between swap and FRA. Swap is having principal plus interest exchange. FRA is having only interest, notional interest exchanged. Okay. Of course, it was out of this question, this topic or this part, but in exam you can be asked anything. Okay, and you are here to get knowledge. So that's why I'll try to give whatever I am having over here. Okay. So next question now. So in this question only, how many questions have we covered? 1, 2, 3, almost 4 questions we have covered on the same topic. Which of the following are the reasons for high treasury risk? High treasury risk. Low funding is required due to high leverage, which may result in strict loss of capital. Large size of transaction. In treasury, transactions once confirmed are irreversible and may result in huge short-term losses. What are the reasons of high treasury risk? Why do we call this treasury business as high risk? Why? Think over it. Low funding is required due to high leverage. What do you mean by leverage? What is this word leverage? Leverage means buying further on the same asset. I'll give you a simple example of leverage. Very simple. Let's say I'm having a house or let's say home loan. I'm having a house, let's say house. Okay. I'll take this house and keep it with you as a mortgage and get a loan on this. So house, I'll get LAP, loan against property, right? I'll get because this house is existing, so I'll get a LAP on this. What will I do? Let's say this house is for 1 CR. I'll take a LAP on this for around 70 lakhs. Okay, 75 lakhs. Let's consider 75 round. 75 lakhs. What will I do with this 75 lakhs? I'll buy another house. House 2. Okay. Again keep it with you. So LAP 2. Again you will give me 75 lakhs means again 75% of that. Okay. So something around, let's take it round. Roughly, let's take 50 lakhs. Round, let's take it 50 lakhs. So LAP 2, 50 lakhs I am having. What am I doing? Again one house 3 of 50 lakhs. Again LAP. What am I doing? Did you understand what is happening? From the single house of 1 crore, I have taken a loan of how much? 75 lakhs over here, 50 lakhs over here. So 1 crore 25 lakhs. Plus further, this will go on until the amount becomes 0. So on the same house of 1 crore, I am taking a loan of around 2 crores. This is called as leveraging. Tomorrow, if imagine the housing market goes down, all the price of the houses goes down, what happens? All my houses are down. All your labs are NPA. All your labs will become NPA. That is called as leveraging. Okay. So this was one important point which I wanted to discuss. Okay. Next. So high leverage. Now this was a lame example I gave you, basic example, so that you understand this leverage. But treasury we do the leverage. Leveraging is an important part. See, there are 3 things in treasury: leverage, hedging and arbitrage. These 3 words are constantly used in treasury, and treasury works on these 3 only. Okay. So high leverage, which may result in straight loss of capital. Large size of transactions done. So that is done. In the treasury, transactions once confirmed are irreversible. You cannot cancel it. That's also true. How many of you have bought call and put options? Have you worked in call and put options? They might be knowing. Once you buy the call or put, done, gone. You buy the shares. Many of you might be buying the shares also. You buy the shares, once bought is gone. You can't reverse it. No, sorry. Sorry, no sorry. No sorry, no thank you. Money is gone. Okay? So the answer is all. 1, 2 and 3. Okay? In the treasury, VAR is used for which purposes? So in treasury, VAR is used for what? Number 1, to calculate the potential loss while holding a trading position in foreign currency and securities. Potential loss means which loss can occur. See here, potential means it has not occurred right now. It might occur in future. Okay, so potential loss while holding a trading position in foreign currency and securities. Second, it is used for long-term risk management. Long term. Okay. So get the answer. I have given certain explanations over here that I will show you later. First, give me the answer. Where is VAR used? Yes? Generally, remember, VAR is used, value at risk is used for short terms, okay? While holding a trading position in foreign currency and securities. Trading position, while holding a trading position. Trading is always for short term. Trading is never for a long term. Okay? So one is right. Long term risk management cannot be done using VAR, but see, nowadays we have models for that also. Means practically I'll tell you 90% times VAR is not used for long terms. But we have to go as per your books. As per the books, VAR is available for long term also. It is available. I can have a VAR model. See, theoretically everything is possible. I can have a VAR model for 10 years. I can have it. Value at risk. I can do the calculations. Practically it's not done, but you in your exam you have to go as per your books. So it is used for long term risk management. That is also true then. Okay, so the answer is both 1 and 2. Now look at the VAR types. Why have I written over here these parts? See this. Okay, look at the VAR types. The VAR types over here are, which are the VAR types? See, these are the 3 VAR types. It's not expanding over. Okay. So, historical VAR, 3 VARs are asked in the exam. Historical VAR, second is parametric VAR, third is Monte Carlo VAR. Anything can be asked to you in exam, or even the names of the 3 can be asked. Historical means 1 into percentile loss into portfolio value. Remember this formula. Parametric VAR means -1 into Z score into Z score means what? What is the Z score? Altman Z score. Z score into standard deviation of returns into portfolio value. Then Monte Carlo VAR -1 into percentile loss into portfolio value. These 3 formula you remember by heart. Or at least the names you remember, because in exam they might ask you what are the various types of VAR. Okay, so historical, parametric and Monte Carlo. These are the types of VAR. Okay, got it? Next. Which of the following is a capital instrument permitted for receiving foreign investments in Indian company? How can I get the foreign investment in Indian company? Now, here, one thing you note, there are various instruments. One of them is given over here, but it's not that only this is the instrument. There are various others also. I'll tell you later, but first answer this. Which of them is allowed for foreign investment in Indian companies? Means, let's say tomorrow BlackRock, BlackRock is the biggest company in the world, investment company. Okay. So tomorrow if BlackRock wants to invest over here, how will it invest? Through government securities? Here we are talking of Indian company, private company we are talking of. So government securities, T-bills or equity shares, and all of the above. If I am talking of government securities, BlackRock will invest in Indian government then. There are investments, kindly note. Private companies from foreign invest in government also. They invest through these government securities. T-bills, again, the T-bills are a short-term instruments, but they are related to government. So what is the answer for this? Comment section. Everyone, comment section. It is equity shares. Okay, equity shares. So the foreign investor can invest through equity shares. Now, what did I say earlier? This is not the only instrument. Equity shares is one. There are various others. There are FCCBs, foreign currency convertible bonds. FCEBs, foreign currency exchangeable bonds. Okay? Foreign currency exchangeable bonds. There is ECB, external commercial borrowing. ECB, external commercial borrowing. So that is also there. Okay? Plus others. These are only few which I have given. There can be many. We have a separate topic on this. This topic is called as ECB, Module A. Module A in your BFM has a topic called as external commercial borrowing. In that you have everything, FCCB, FCEB, ECB, plus others. Many are there. Okay? So that's why I am saying join the batches. Join the batch immediately. 21st, new batch is starting. Join it immediately. I'll show you at the end. Okay? Join the batch immediately. Focus batch. Okay? Which of the following are the objectives of using derivative products in treasury? Means why do we use derivatives in treasury? To manage the liquidity ALM risk, to meet the requirements of corporate clients, to trade in currency and rupee derivatives. All of the above. Why are derivatives used? Here, what is the basic aim of derivative in banking? Banking I am talking. Derivatives, basic aim of banking is to manage the risk. Now, how to trade in derivative? What is the use of derivatives? I'll give you a simple example. Let's say I buy a very simple example. Let's do it. Let's say I buy Reliance shares. Reliance. I buy the Reliance shares. Okay. At let's say 2500. Right now it is roughly around this only, plus minus something. So I buy the Reliance share at 2500. Okay. Why am I buying this Reliance share? Why did I buy? Do I want this share to go down or do I want this share to go up? Comment section, everyone. Why did I buy this Reliance share? Do I want it to go down or up? I want it to go up. So, when this share will go to 3000, I'll sell it. Okay. This is my normal position. This is called as long position. Long. Long means what? I buy first at lower rate and sell later at a higher rate. Okay, that is known as long position. Now there is a problem. Why have I brought this share? So that it goes up and I'll sell it. But tomorrow if it starts going down, then what? From 2500 it starts going down to 2300. I'm in a loss. My long position is gone. Now to cover this long position or this downside risk, I'll buy a derivative or I'll buy a put option. I'll buy the put option. So this is known as derivative and this is the main use of derivative, at least in banking. This is the main use of derivative. So the use is to protect your long position, or even reverse can be true, to protect your short position. Short position can also be done. Short means what? I'll sell first. Let's say this Reliance is at 3000 right now, and I'm expecting it to go to 2500. Reliance is at 3000. I'm expecting it to go to 2500. What will I do? I'll sell this first at 3000, and when it goes to 2500, I'll buy it again. So net I've gained how much? I've gained this 500 rupees. But imagine the reverse case now. I've sold it for 3000